A staggering 13.12% of outstanding credit card balances have now crossed into over 90-day delinquency territory. You should pay attention because this delinquency level has reached a 15-year high, rivaling conditions seen after the 2008 financial crisis. The reality is that $1.25 trillion in collective credit card debt is exposing deep cracks beneath seemingly stable economic headlines. You can see how many consumers have exhausted the financial cushions they built during the pandemic years. Sustained inflation and elevated interest rates have created a pressure cooker that many households can no longer withstand. You are looking at a growing population of borrowers who are trapped in a cycle of debt with limited paths to recovery. The real concern is not just the amount of bad debt, but how quickly accounts are deteriorating. Financial institutions are seeing borrowers move from current status to severe delinquency much faster than expected. Traditional intervention strategies are becoming less effective because warning windows are shrinking. You should recognize that this crisis is being driven primarily by existing borrowers rather than new credit users. Many consumers relied on credit cards to preserve their lifestyles during the inflation surge of 2022 and 2023. Those same borrowers are now struggling under the weight of higher borrowing costs. Lenders are confronting simultaneous threats to both asset quality and future liquidity. You can see how accelerating write-offs could place additional strain on financial institutions. The 13.12% delinquency rate highlights a major failure in affordability assessment models. Wage growth may have appeared positive on paper, but it failed to keep pace with real-world living costs. Household debt may seem stable at $18.8 trillion, but revolving credit debt tells a far more troubling story. You should view credit card delinquency as a leading indicator of potential weakness in consumer spending. The traditional lend and collect model is becoming increasingly outdated in today's economic environment. Borrowers are facing challenges that extend far beyond individual financial decisions. Many risk models failed to recognize how fragile consumer balance sheets had become. Credit scores remained elevated during stimulus years, creating a false sense of borrower strength. You may have encountered borrowers who looked financially healthy on paper but lacked real resilience. These so-called phantom prime borrowers are now exposing weaknesses across lending portfolios. Institutions that loosened lending standards in 2024 and 2025 are now paying the price. Standard collection approaches are delivering weaker results as financial distress deepens. Impact Solutions argues that the industry remains trapped by reactive thinking instead of proactive intervention. Waiting for a missed payment before taking action often means the damage has already been done. You would never wait for a car crash before checking the brakes. Yet many lenders apply that exact logic to credit risk. Months of behavioral warning signs frequently appear before an actual default occurs. Transaction patterns often reveal distress long before delinquency metrics catch up. Impact Solutions highlights how disconnected teams within financial institutions create unnecessary risk. Growth-focused origination departments and recovery-focused collections teams often operate without shared intelligence. This lack of coordination has contributed to the buildup of enormous credit exposure. You should understand that many consumers have been using revolving credit as a substitute for income. Treating delinquency as an isolated borrower problem misses the broader affordability crisis. A credit crunch becomes far more likely when systemic issues are ignored. Many collection programs still rely on rigid processes that fail to reflect individual circumstances. You can see how one-size-fits-all recovery strategies often push struggling borrowers closer to bankruptcy. Personalized engagement has become essential in modern credit risk management. Impact Solutions emphasizes that static credit bureau scores are no longer sufficient for ongoing risk assessment. Capacity to repay changes constantly, while traditional credit scores remain largely fixed snapshots. Institutions need visibility into real-time financial behavior rather than historical assumptions. AI-driven early warning systems can help identify distress months before severe delinquency emerges. You can intervene far earlier when behavioral signals are analyzed continuously. Proactive restructuring can prevent many accounts from crossing into default territory. Intelligent digital collections can improve engagement through channels borrowers actually prefer. You are more likely to receive a response through personalized digital communication than aggressive collection calls. Automated repayment solutions can reduce friction and encourage constructive conversations. Advanced segmentation allows lenders to distinguish between borrowers who cannot pay and those who simply choose not to pay. You should allocate resources differently depending on the underlying cause of delinquency. Flexible repayment products can transform troubled balances into manageable obligations. Partnerships with debt management fintechs can create better outcomes for both lenders and borrowers. Cash flow-based underwriting offers a far clearer picture of repayment capacity than traditional scoring alone. L-Impact Solutions believes the future belongs to institutions that become financial health partners rather than passive creditors. You must embrace resilience-first banking, dynamic risk management, and AI-driven engagement, because those who cling to outdated models risk being overwhelmed by the next wave of bad debt. Is your risk model blind to the coming crash? Comment your opinion. To learn more analyses, link in bio. Thank you.